Good afternoon and welcome everybody. This is the third in the series of our tax year end masterclasses, and this is everything EIS, Enterprise Investment Schemes. We're going to look at client opportunities and manager insights, and I'm joined today by Katie from our ventures team, who will tell you more about how we invest. My name is Dominique and I'm part of the EBDM team here at Blackfinch. So important information, these slides are designed for advisors. They're not designed to be used with retail clients. If there are any slides you would like to use with retail clients, just let us know because we can pass it through the compliance, get the relevant risk warnings put on and send them back to you. So that's not a problem, just don't use them as they are. Also, of course, as we're talking EIS, there are extra risk warnings we have to put in because bless the little FCA, they do say, and stamp it on the brochures now, do not invest unless you're prepared to lose all of your capital. Now, to be fair, that is a good point with EIS investments because they can fail and every single one in a portfolio could go bust. That would be pretty bad luck, but it could happen. But of course, what they don't take into consideration is that for some clients, they could have gained up to 94% tax relief. So then you have to think, actually, how much capital was I really risking here? But we do have to put those risk warnings on. But then you get your head around loss relief when you're talking to clients, I find. But anyway, learning objectives. This is CPD qualifying, so you will get an hour of CPD for sitting through this session. And that would come in a couple of days' time usually. What I would ask you to do is at the end of the webinar, we are going to ask for feedback. So when this finishes, you'll get a feedback form pop up. It literally takes 1 minute to complete, but we really would appreciate your feedback. But it's on there as well. You can request the slides if you'd like them to refer back to. But learning objectives for today, we're going to learn and summarise how and what the ventures team actually invest into when you invest in our EIS. You'll be able to outline the different tax reliefs in an EIS, explain when and how the different taxes can be reclaimed. So I'm not going to be one of those just tells you all the benefits of a plan. I'm also going to tell you all the difficulties and what to look out for, because it's those things, if you do an EIS, can trip you up later on. And I'd rather I told you everything, if you like, warts and all, because that's what you can tell clients. There's no nasty surprises when they realise they have to fill in 10 EIS certificates, for instance, to claim back capital gains tax. We're going to look at the types of clients, typical clients for an EIS as well. And as I said, I am going to look at the disadvantage as well and what you can get tripped up on or common misconceptions. But for those of you who are not familiar with Blackfinch, just a little bit about us. Inspired by Charles Darwin in Darwin's Finches, we're all about adapting, evolving, because if you adapt and evolve, you can thrive. Now, you as advisors, you know this better than anybody. With everything the FCA throw at you, then the budgets come. You've got to be adapting, evolving all over the place. Because if you don't, well, you'll probably retire because you'd have had enough of it. But this is what we're all about. We need to keep agile. And on that, we've actually released a new product today, which I'll talk about on the next slide. We've got over 30 years track record in the tax efficient space, and we've got experience across multi-asset investing, renewable energy, property, AIM. So we do AIM as well, not just the Adapt IHT, which is the unquoted side. And of course, we have our VCT as well as our EIS, run by the same team as you're going to hear from today. We have a smidge under 1 billion in funds under management. And yes, I am expecting a good party when we get to that 1 billion point. I'm hoping the CEO might listen to this webinar at some point, so he knows I'm expecting a party. We've got over, I think it's around about 150 people now across the UK, because it's not just people here in the Cotswolds. And we are a UNPRI signatory committed to responsible investing, what I used to call in the old days ESG. We are investing for good. So everything we invest into, we do think, is this going to change somebody's life? Is this going to have a better outcome? And that's the sort of thing we're looking for when we're choosing investments. And that's right across the board here at Blackfinch. So what do we have as solutions? Well, we have our Blackfinch Adapt IHT service, which I just mentioned. That's our unquoted or unlisted IHT one. That's the one you now have your £2.5 million per person allowance at the full 40% relief. Everything over and above that, of course, is 50%. And I am doing a specific webinar next Thursday on business relief planning, if you like, the advanced uses of it. It's really useful if you're talking with solicitors, because it's also how it interacts with trusts and things like that as well. Again, really underutilised in that particular space. Probably our standout point on this one is that we have never had a negative period. It's never gone down. It's not been exciting. Okay, we only target 3 to 5% per annum. And I often say to people, they say, Dominique, you make me 10. No, we'd have done something horribly wrong if we actually made you 10%. No, it's a steady eddy. It's really dull. It does exactly what it should be doing, and that 3 to 5% target return over the medium term. But as of today, we've actually launched an insured version. So you can have a 2-year life assurance added on to this, and it's just basically a 2-year group life policy. So if you have anyone who wants the certainty of that IHT saving, do speak to your local BDM. As I mentioned, we also have AIM. To be fair, not overly popular at the moment. We're doing an awful lot actually of transfers from AIM into our Adapt one to get that 40% relief again. But of course, AIM's had a terrible time because of the markets, client sentiment, investor sentiment, you name any sentiment, AIM is affected. So it's down quite a lot. And then, of course, the government has changed the rules. So from April, you're only going to get the 50% relief. If you do have clients currently invested in AIM and they want to make the move to get the 100% relief, we are offering no initial charge on all those transfers, whether they're held with us or any of our competitors as well. So again, speak to your BDM about that. We also have another business relief plan, and that's our Blackfinch Corporate Management Service, and that's for businesses. It's for those companies who have too much cash sloshing around. It's not being used as part of the trade. Now, you as advisors are normally saying, come on, put it in your pension or take it out. Let's put it into a VCT or EIS. This particular plan is for those people who say, no, I want to leave it in. I might buy another business. I might buy another property. It's that comfort blanket half the time. The trouble is with having too much cash in a company is it doesn't qualify for IHT. It doesn't qualify for business relief. And of course, they think it does because it's in their company and their trading business. But it's actually deemed as an accepted asset. That's EXCEPT, accepted asset. It won't get business relief. So what we do in this plan is basically get that money trading again. And actually, the majority of the cases, it's actually immediately exempt from IHT for them. So it's a really good plan. So again, if you're working with accountants or you're working with businesses and they do have a rump of cash in there not being utilised, do speak to your BDM because we have a very simple and easy solution there. On Tuesday, if you join me, we talked about all things VCT and why this year is going to be such a bumper year with that 30% tax relief before it goes down. So that one's open. Just to let you know, we have actually declared a dividend. That's going to be payable on the 15th of May, and that's for everyone invested this side of the tax year. So you're going to get your 30% tax free, your tax-free dividends, your tax-free growth. It's your nice, simple, easy one if you're looking just to get your tax back. That's your income tax, I should mention. And that's a 2.5p dividend. But today we're going to concentrate on the EIS and everything that makes this one really special. And then lastly, what we have at Blackfinch, and a lot of people don't realise this, is we have what I call normal investments. So we have the normal asset management side where we offer managed portfolio services, and now what I like to call in non-fund manager speak, tailored portfolio service, which is basically an MPS on steroids, which is basically where we work with you as advisors or as a firm and say, right, you don't want to be a manufacturer. If you're picking stocks yourselves, you don't want that risk. but actually work with our fund managers. What would you like to see in your portfolios offered to your clients? Unless you're completely mad, which I doubt you are, then we can work with you and actually say, okay, right, so you want to be heavier in blah. That's a technical term. We can do that with you, but we can work and literally make it bespoke and tailor it to exactly what you want for your clients. So if you are actually thinking this might be of use, again, speak to your BDM. Or if you think, well, actually, I've got my annual CIP coming up anyway, which I need to review, we'd be delighted to have a look, even if it's for you to say, do you know what I'm doing now is exactly right. That's absolutely fine. But give us the opportunity to have a little look and see if we can add any extra value for you. But without further ado, I'm going to pass you over to Katie now, who's going to take you through what they do in the Ventures team. Over to you, Katie.
Thanks, Dom. So I'm Katie. I work within our Ventures team as a product manager. So our Ventures team here at Blackfinch consists of 12 members. We're headed up by Dr. Dan Appleby. He is our CIO of Ventures, but he is also CIO of our asset managed investments too. And then within our ventures team, we're quite nicely split up into 3 sub teams. So you've got our portfolio team who looks after our existing investments. That's headed up by Rich Harley. He's actually an ex-founder, so he exited an edtech business. So he's got that sort of first-hand, real-world understanding of, the stresses and strains on these businesses we have in the portfolio. We also have Kim. She heads up our deals team. So that's everything from sourcing the new deals to looking after going through the legal process and executing when we make new investments. And she's got a really strong background in investment banking. And then we've also got the product side to our team. That's headed up by Nick Pillow. He has a PhD and he is also an ex-founder. The one thing that's really nice about our ventures team is we're not your typical full finance background. I personally have a finance background, but the rest of our team is made up of entrepreneurs, academics, and professionals that have that first-hand experience. So when we're going out there and we're speaking to businesses, we can speak to them on terms that are easily understood. But then when we're assessing deals, it means we've got a full range of backgrounds to comment on the deals and bring different perspectives and reduce that bias. The good thing about Blackfinch, as Dom explained, is we have quite a broad range of investment experiences and a broad range of sub-teams, which means we can leverage on those other departments within Blackfinch. So for some of our deals, we can leverage on the energy team or our property team, and we've got a really robust experience throughout our Blackfinch group. The other nice thing about our ventures team is every member of the team acts as an observer on our underlying portfolio companies. So I personally sit on 4 companies as their board observer. So we get first-hand experience of what's going on in those companies. We don't invest and just let the money run wild. We're actually involved in how the companies are progressing day to day, which is really, really nice. In addition to our core team, we also are supported by a wider range of venture partners. So our venture partners are all experienced founders. They've been in the industry, they've seen those real world problems, and they're a key value add to our portfolio companies. If you speak to any of our portfolio companies, that's the one thing they really love about Blackfinch is we can put somebody in that company who's been there and done it. They've seen the teething problems, they've got the connections, they know how to fix things. We don't always keep the venture partners the same the whole way through the company progressing through its lifespan, because some of our venture partners will be very good at the earlier stage of investment. But once that company's sort of grown and they've got perhaps a different set of problems or a different set of challenges to contend with, we can change that venture partner out for somebody who's got more relevant experience to those companies. So Geraldine there, she's got a wonderful background in marketing. She scaled and exited a business within 4 years. So she can give her portfolio companies real hands-on marketing expertise. But they really do love being involved with the companies. They're not just there to rock up to the board meetings that are held either monthly or quarterly. They will do one-to-one strategy sessions with the companies. They'll do workshops with them. So they're really embedded in hands-on. So it's quite a nice network that we've built out and is very differentiated from what else is available in the industry. So our EIS portfolio as a product, it is a generalist portfolio. So we will look to invest in 10 companies in a range of sectors. EIS, I appreciate, can be a niche product, and for some investors, it's their first step into sort of venture capital investing, can be a little bit scary. We like to make that as, comforting as possible in the sense that your clients or yourselves would be invested across a diverse range of companies. So they have to have a technological basis to qualify for the EIS risk to capital condition. But provided they meet those conditions, we'll invest across a range of sectors. Having said that, we have identified three key themes when we've been sourcing deals. And these are things that we've identified as sort of high growth areas that we can not only sort of invest into, but we've got specialist knowledge into that we can leverage and look at those themes quite deeply. So the three that we've got at the moment are fintech. So this is sort of anything to do with finance, personal finance, but also digital payments and background lending technologies. So they improve sort of how individuals and businesses manage their money. Some well-known fintechs you may have heard of, the likes of Revolut as well. So fintechs tend to be your big exits that you'll be well known in the industry. Alongside that, another one of our themes is deep tech. So this is science-based innovations that solve complex problems using advanced technology. The one thing I would reiterate here is sometimes when clients hear deep tech, they get a little unnervy because they think, oh, is that a really early stage business? That's not the case. They're not all really early stage and they're not really risky. So a lot of the deep techs that we look into, they've already got revenues or they've got commercial partnerships, which de-risks some of that, you know, early problem stages they may be trying to overcome. So deep techs in the EIS portfolio, we have an example which is Kelpie. They basically are solving two problems. One is advanced materials, but also the plastic pollution problem. So they make seaweed-based packaging, but there's a lot of research into that. They've got great partnerships with the likes of Holland and Barrett, and they've also got Unilever, so some of your household names as well. The last one on here is energy transition. So energy transition in the sense that we're looking at it is looking at technologies that accelerate transitions away from fossil fuels in consumption. It's not energy generation. Under the requirements of EIS, you couldn't just do producing and selling energy anyway because it wouldn't be allowed. But this is looking at technologies that help sort of move to a lower carbon economy. One example that we've got in the EIS portfolios is Adia. So in terms of their tech, what they do is rather than having to replace all your heating when you want a heat pump, they have a special valve that essentially allows you to use your existing radiators, which cuts the cost down quite significantly for installers. So those are the three growth themes that we want to highlight within the portfolio. But just to reiterate, we are definitely a generalist portfolio and you will be diversified, or your clients will be diversified across sector and stage. So just to give you a couple of examples of companies we've got in the portfolio, the first one I want to highlight here is Currency. Currency's gone on quite an interesting journey since we've invested into it, and a really positive one. So Currency is a fintech business. They started off offering the lowest FX fees when you're traveling abroad. As many of you may know, when you've gone abroad and you've done a bit of spending on your card or you've gone out for dinner, there's nothing worse when you come to paying the bill and then you've got a whacking great charge on the end of the bill because they've used a high FX rate. Highly infuriating. The good thing with Currency is it links to your existing bank account. You can get it in a card form or you can have the app straight onto your phone. You don't have to open up a new bank account, and it means when you're going to pay for these via open banking technology, you're getting the lowest FX fees, which frustratingly, when I had signed up for Currency when I went abroad 2 years ago, I wouldn't have got stung by my credit card provider who told me they were FX free. But unfortunately, I've got to tell the bank that I was going away and they declined my card. And I had a whopping great FX bill, which was not too pleasing to me. Since the point of investment, Currency has also expanded its range of offerings. And what they've now gone into is loyalty debit cards. So you may have seen with some loyalty providers, you can get a credit loyalty card, which is a bit frustrating if you don't want to spend on a credit card. So Currency has partnered with some household names to make loyalty debit cards. They launched their first one to market with Hilton Hotels, and it had a really, really great response. Absolutely fantastic uptake in number of cards, meaning their customers could earn loyalty points while spending from their debit accounts. On the back of that partnership, they had strong demand for other partnership cards, and their most recent one has been launched with Marriott Hotels as well. So still in the hotel industry, but has been had a record uptake in number of cards. So this new move into the partnership cards has been a really, really strong market for them. They're still sticking to their core brand with their FX cards, but this gives them a new route to market as well that's well supported by household names. They are also backed by the likes of Mastercard, so they've got really strong market presence on there as well. But that's just an example of one fintech that we've got in the portfolio. The next example that I want to highlight for you is just something a little bit different, just to show that, not every investment needs to be super technological, needs to be super exciting, needs to be doing something out in space, for example. We do have those investments within our ventures team, but just to give you something every day that you might be able to relate with is Spotless Water. So what Spotless Water do is they actually make ultra pure water primarily for window cleaners. Um, Rather than the window cleaners having to supply their own, which takes a lot of effort and you need a lot of space and a lot of equipment to do it, the window cleaners can just rock up to the stations, fill their vans up, and off they go. Um, can be used by the likes of solar panel cleaners as well. Also, there's applications in dentistry and brewing. The good thing is with Spotless Water is it's something that either you or your clients might be able to see out in the real world, because these stations are now being rolled out with the likes of Morrison's. So if you rock up to your local Morrison's in the car park where you may see the car wash, you're likely to see a Spotless Water stand where individuals can go and fill these stations up. So it just highlights that it's not the craziest ideas that we look to invest in. The really good thing about Spotless Water is they have no national competitors in this country, and they're a really scalable business. So it's just a nice everyday story if you're speaking to your clients, or if you're out and about, that's actually an example of some investment that you will be able to see in the real world. So in terms of how we pick our investments, it's quite a robust process. We actually have 7 stages, although I argue there is one stage in between stage 3 here and stage 4, which I'll come on to. So every year we look at about 1,000 opportunities. As you can imagine, we don't invest in 1,000 opportunities. So our deal team very carefully go through all 1,000 opportunities within our sub-deal team. They review them, and then the ones that they think have a greater level of potential, either because they're at the right stage or the right fit for us, they will bring to our filtering sessions. We have 3 of these a week where every member of the ventures team joins. And those opportunities we will sort of interrogate. The good thing with our team is having that range of backgrounds means everybody's got a different viewpoint and we can reduce bias looking at those opportunities. So everybody's got a chance to, give their opinion, give their views on it. And we're really interrogating to see if have we assessed areas that perhaps maybe just the deal team on their own haven't thought of. If at that point we decide, okay, there's enough people here that think this opportunity is a strong enough one, we'll move it to the pitch stage. So the pitch stage can be quite intense. They tend to be about 3-hour sessions where you'll have senior members on the team of the pitch plus the deal owner themselves, and we'll interrogate this business to see really what's going on under the hood. So how do they run the business? What's their business plan looking like? Do they know their competition? But also you want to get a feel for the founders. You want to understand how they want to work, what their plans are, how they think they're going to finance the business moving forwards. The one thing I would say here, though, is investment is a two-way relationship. This isn't just an opportunity for us to look into the business, but it's an opportunity for that potential investee company to see if they want to work with us, because this is going to be an ongoing relationship for a number of years, and we want to make sure that, we can work quite frictionless between ourselves and the investee company. Provided we're happy at pitch stage, as I said earlier, there is sort of a 3.5 stage here, which is where we now go to visit these companies in person. So our team itself is based throughout the UK, which means we're quite nicely primed to be able to go and see any opportunity that is around. And we will go out to those companies. What's really nice here is you can get a feeling for how the business actually runs when you go in and see these individuals. You can see how their team works, how the founders have a handle on things, but also sometimes you can get an understanding of where we can help or who might be the right venture partner for this business. So it gives us a real insight into these businesses we may not have got if we'd just done the pitch, over a video call, which is really nice. On the back of that, we then go out to our investment committee. So this is a team of three. It consists of one internal member, who is our chief technology officer, and then we have two external members on here as well. So they've got sort of real world industry experience, and they will initially review the deals to see if there's sort of any red flags that come up or raise any questions that perhaps us ourselves have not thought of or any other of the bench team members have not thought of. So it's kind of a sounding board at this stage. Provided they're happy with the initial assessment that we've done, we would then move into a robust due diligence stage here. This can take a number of weeks. However, having said this, we can move faster or slower depending on the deal rounds because some companies are looking to close deals quicker. I would say, though, that even if we're looking to close a deal within 2-3 weeks, we are not going to reduce down the due diligence we're doing. We're still going to get a technology expert to look into it. We're still going to dig into the commercials of the company. We will still look over the legal agreements. Everything will still be thoroughly due diligenced, even if we are reducing that time frame down. In the same way that if the company's not planning on closing around for a couple of months, we'll still do the same level of due diligence. The one thing I would reiterate here, which will be key to you and your clients, is for every deal that we do in terms of investing EIS money, we ensure that we get advanced assurance. For those of you not familiar with advanced assurance, what advanced assurance basically is HMRC's confirmation, which is given prior to us investing the money, that the company is likely to qualify for EIS. In terms of EIS, you have to meet a certain level of criteria, such as risk to capital, i.e., it has to be carrying out particular businesses. You couldn't, for example, be running an investment business, or you couldn't be operating hotels. So we help the companies to do this EIS advanced assurance process, which they really like as well, because some of the forms can be a bit confusing and some of the legislation can be a bit confusing. So we will sit and work through the companies on this application, which actually they really, really like because they're not left to do it on their own. The other thing that we do, and some other funds may not do, is we look to get an advanced tax opinion on these companies as well. And we won't invest into any company for EIS unless we have advanced assurance back from HMRC and we've got the tax opinion. We require both of those things before we put any client money in, because there's going to be nothing worse for you or your clients if we've invested into a company and then we can't get the tax relief. We've never had that happen before, and I would hope so we won't ever have it happen in the future, but that's the level of reassurance that we want from our investments. Once we've gone through that due diligence stage, we will then go out to finalise the approval, provided they're happy with it and there isn't anything that crops up. I will say there has been deals that we have dropped at later stages just because some things have occurred, but provided everything's as it should be, we'll look to approve it and then invest. Sometimes there can be a lag between us approving it and us investing the money, and that's purely down to either it's a larger round and there's other investors coming into the round, or just in terms of time constraints with tax year end especially, we're looking to close deals by a certain period. So sometimes there is a lag, but once that's approved, we would then look to invest. And then stage 7 here is really the monitoring and support that we offer the companies. So as I said, everyone in our ventures team acts as an observer on portfolio companies. And then we also have our venture partner, Ned. So you're sort of getting 2 representatives from Blackfinch, but 2 sort of beneficial representatives that are helping these companies. We're not just putting one of our own team on as a Ned, because sometimes that can be a little imposing to the companies. Putting someone on who's got that real world experience is actually giving a benefit to these EIS portfolio companies. We review the whole of our portfolio every single month. So every member of our ventures team sits down and we go through the whole portfolio. So everyone is aware of where the company's at, what their strengths are, where we could offer them more help. If they need additional fundraising later as they scale, we can assist with that as well. So we're really on top of where everything in that portfolio is. In terms of the EIS investors, the one thing we do for our portfolio companies as well is we make sure that we get the EIS 3 certificates done, because until your client has that certificate in their hand, they can't go and claim their tax relief. Unfortunately, timeframes for EIS certificates are out of our hands because they're controlled by HMRC. But I would say on average across the portfolio of all the tranches we've done since we've been running this, we get those EIS 3 certificates back in 1.3 months. There aren't any that are sat laying around because we help our companies do the applications for the EIS 3 certificates and then we get them issued as well. So our companies really like that because they're not having to write out the EIS 3 certificates for our clients. And it also means hopefully we can get them out a bit quicker once we get that approval back from HMRC. So in terms of timeline, the way our EIS portfolio works is we look to invest across a minimum of 10 companies within 12 months of investment. Now, I know some of you here are going to say, well, I would like my clients to be invested by tax year end. Well, we absolutely can offer that, and we absolutely do. So provided that you've got applications and funds in by March the 25th of this year, we will deploy your client this tax year. The one thing I would note is if your client does want deployment in this tax year, there is a waiver to sign. The waiver will say you may get a lower number of companies than 10, but looking over the last 5 tax years, we've never failed to fully deploy clients by tax year end. We just have to have the waiver there so that it's signed, but we have always exceeded a minimum of 10 companies over the last 5 tax years. This graph here sort of is more looking if you've got a client that's invested post-tax year end. So say if you've invested in August, the majority of our investments do tend to be towards tax year end just because of the nature of when EIS funds are deployed, but we do investments throughout the year as well. So for example, we did deals in December as well last year. So this just highlights that funds can be deployed at different periods of time. You will get a welcome letter that tells you we've received the funds, and then you'll also get certificates once we have deployed funds into companies. The one thing here with EIS is not every company is going to make a 10x return. It's just not the nature of every startup. If every startup company was going to make a 10x return, I'd be out of a job. The good thing about highlighting here is it does show the period of time it can take for companies to exit. Generally, with EIS, your failures will come first, and some companies will fail. The benefit you get with EIS is you do get loss relief on your EIS investments, which mitigates the downside risk. So you get your upfront income tax relief and you also get your loss relief. So those two together work quite nicely to mitigate the loss on those portfolios if companies do fail. And then if you've got your exits, obviously, the gains on those EIS exits are free as well. The one thing to note with EIS liquidity, there isn't an option to disinvest once your client has invested, because the only way to get the return from your EIS investment is when an exit event occurs. So what we mean by an exit event is either the company will IPO or it will typically be bought out by a larger company. I would say the way the market goes at the moment, and it has been the last few years, is the majority of our portfolio companies would be looking to be purchased by larger strategics where they're looking for synergies in the business. We just can't give any guarantees on when these exits occurred. Our actual first exit that we had from the EIS portfolio did occur early, but even though clients had to repay their income tax only on that investment that exited early, the return was large enough for clients to be able to mitigate returning the income tax, but also get a strong gain on that. I'm just unfortunately not allowed to disclose it publicly just because the terms of the deal on we did exit. But just to highlight then across our EIS portfolios is we have 42 active companies at the moment. This pie chart here isn't each individual investor's portfolio. This gives an overall view of our ventures EIS portfolio as a whole. What this really here is highlighting that our investments are diversified across stage and sector. So we're looking at earlier investments and trying to balance them with slightly later investments, but from a whole range of sectors as well. We do measure this on a portfolio level too, so that clients aren't being concentrated into one particular sector, which is quite nice. The extra things here to highlight about EIS, yes, there will be a lot of clients that go in for tax reliefs as well, but one benefit you're getting with EIS is you are getting access to, innovative, high growth companies that are typically reserved for the like of your, institutional funds or ultra high net worth investors. The £10,000 minimum investment, you're allowing retail clients to have opportunity to invest in these companies. The other really nice thing here is these EIS companies are based in the UK. They have to have a permanent establishment in the UK to get EIS funding. And it's the job creations that you get off the back of that. So yes, we're putting money into these startup companies, but we've created numerous jobs off the back of the companies that we've invested in. So you can see the real progress when we go through and do our portfolio updates every month of, oh, we've had X amount of jobs created this month. And it's quite nice to see those growth within those businesses as well and exploring throughout the country. So that's just a high level overview of our EIS portfolios. And on the basis of that, I will hand back to Dom to take you through the lovely rest of the tax relief that do come with the EIS.
That's great. Thanks so much, Katie. Really appreciate that. So you've heard about the brilliant investments that we can go into and how exciting they are and how, yeah, like Katie said, normal people can access these rather than just the ultra high net worth having the opportunities. But of course, for our retail clients, they do also get the tax breaks because don't forget, this is a government incentive. Clients often feel a bit bad about getting tax back. And I always say, but you don't get anything for nothing. They're not going to give you something because they're being kind. They are getting 10 times the benefit. We're having to invest for the benefit of the UK economy. Like Katie said, creating those jobs and therefore creating taxes. They want clients to do this. This is why they're giving them the tax breaks. So let's go through those tax breaks. Well, first of all, there's 30% income tax relief. And also you can go back a year. So you can clear last year's tax bill as well as the current year with one check. Okay, it's just a choice on your tax return, which year you use or across both of them. Absolutely fine. You can't claim back more tax than you've paid, though, so you can only reduce your tax bill to zero. So it's no point somebody putting £100,000 in who can only get £3,000 of income tax back, unless they're doing it for one of the other tax breaks, which we'll come on to. So you can't get back more tax than you paid, but you can claim all tax back, all income tax. So earned, pension, savings, dividends, rental income, even taxable event income tax if you sell a bond. So if you do have people with old bonds, perhaps higher charged, maybe not put on a multi-lives assured basis, so you can't do tax planning post-death, and you think, oh, do I put it onto a nice new contract now or something different because we want to do some IHT planning? Sell the bond, give rise to the income tax charge. How much am I charging? Oh, £3,000 of tax. Well, you could put 10 into an EIS, offset that tax. And if it's for IHT planning, the beauty is an EIS also qualifies for business relief. So actually it'd be IHT exempt after 2 years as well. But that's released the rest of the money from the bond for you to invest elsewhere, hopefully into our Adapt IHT portfolio for the IHT relief. But you know what I mean? It's basically getting you out of something you don't want anymore. Do not worry about that. If it's an income tax issue, you can use an EIS, offset the tax. Even a VCT will do that as well, especially if it's not IHT driven. Again, like Katie said, all growth is tax-free as well. Both of those, though, you do have to keep the minimum 3 years to get tax-free growth and to keep your income tax relief. So my first little wart and all disadvantage, if we sell a company prior to the 3 years, and it does happen, okay, normally because it's an offer too good to be, turned away, but if it does happen, then the clients do have to pay back the income tax relief they've received on that one company, not the whole portfolio, just that one company. And growth won't be tax-free because they haven't had it for the 3 years. So capital gains is payable. Of course, though, they could reinvest the gain, and of course, they could defer it. Because, of course, if we go down to number 4 tax break, capital gains tax deferral relief as well. I'll come back to loss relief in a second. And that's probably the biggest reason I find, certainly in the Southwest, why people invest in an EIS. It's about capital gains savings. So again, I've actually got a case study on that one, so we'll look at that one in more detail. But as I mentioned, it's also free of inheritance tax once those underlying companies have been held for 2 years. If you're reinvesting an EIS company, so you've done 2 years, you've done 3 years, you've done 4 years, then it gets sold. If you're reinvesting that into another EIS company or reinvesting it now into an IHT portfolio, you don't redo the 2 years. It comes under replacement property relief. So it actually stays being IHT exempt. So an EIS can be a really good IHT vehicle for some clients as well. It does come under the new 2.5 million per person business relief allowance. Anything over and above that 2.5 million, obviously they get 50% relief. Now, this last one is a little bit misleading. It says permitted maximum investment £1 million per person or 2 million per year, knowledge intensive EIS. Actually, the limits are only due on income tax relief. It's actually unlimited for CGT deferral, unlimited for IHT, apart from that 2.5 million per person now. So actually, you could put a lot more than 1 million and a lot more than 2 million if you wanted to get the IHT relief and the CGT deferral. You're just limited on income tax relief on that either first million or 2 million. So some really great tax breaks here, and we'll look at loss relief a little later on. Now, will my slides play with me? They do eventually. But why invest in an EIS and why Blackfinch? Well, hopefully after Katie's talk, you can see how thorough we are. We were certainly hoping you'll never have an investment that doesn't get its tax certificate, because not every company out there can say that. But obviously, we've not just got the attractive tax benefits. We are actually diversifying you across at least 10 different companies. So some people say to me, oh, Dominique, it's EIS, it's really high risk, and I'm going to put it through 3 different companies. Actually, we're doing it for you. We're already diversifying across 10 plus companies. So you probably don't need to go to another manager and have any more. We've already done it for you. These are high risk, so we do want that diversified portfolio. And do be careful, we'll come on to other disadvantages, but you are going to have a certificate, a tax certificate for every single company you're investing in. So if you did invest in 3 EIS portfolios and they also did 10, then you're going to end up with 30 different certificates. That could be a paperwork nightmare, so just be careful on that one. And I always think divide any amount by 10 and it's not nearly so scary. So, even if you're investing £300,000, you're thinking, yeah, but that's only actually 30,000 approximately per company. That's not nearly as scary, as having 300,000 in one thing. It's not one thing, at least 10 different companies. We also do invest very quickly. So if you're investing on the 6th of April, we're going to say allow us 12 months and we're going to invest some throughout the year. But what we do is actually also do a lot of follow-on investments at the end of the tax year, because we've got some brilliant companies in our portfolio, and brilliant companies need more money because these are growth companies. They need more money to grow, become global, to produce other things. So all the best ones we want to give follow-on money to. So actually what we have is a rump of companies at the end of the tax year for these follow-on ones, because we know what clients are like. They always leave it right to the last minute. So they've got until the 25th of March, application cleared funds in. If it's in then, we will still have you diversified across at least 10 different companies in a portfolio by tax year end. And like Katie said, I can't understate this actually. We do get certificates back really quickly. I often say, look, think or say to your clients by the end of June, which is really quick for an EIS, by the end of June, you should have all your certificates. Also, what we have is a portal. We keep them all nicely, safely on there and logged. So there's no bits of paperwork coming through the post which they've misfiled, can't find. It's all there. Then when they want to, they can download the lot and email them straight across to the accountant. So we're keeping it really simple and easy for them. But other reasons, well, you are supporting smaller growing companies. It is exciting. An EIS by its nature is never going to be a whole person's portfolio. But as part of an overall diversified portfolio, it is something really quite exciting. And you've got such great tax breaks. Most people do go, well, this is really exciting. No, I'm not going to put, my life's earnings into it, my life savings. But actually, I'd quite like a bit in this. And let's see how it goes. Because actually, when we take into account the tax breaks that I have, how much am I really risking here? And that comes on to diversifying tax wrappers. You've done your pension, you've done your ISA, you might have done a VCT. Well, what else? Why not a bit into an EIS? We start at just £10,000 minimum premium. So it's not for just your ultra high net worth. This can be for relatively normal people if they want to and if you deem it a good idea. So you're accessing alternative asset classes, which again aims to actually help diversification as well, because that's not going to overlap with anything else they've got in a portfolio. So let's have a look at CGT though, because this is the one that I tend to find people use EIS for the most. Usually we've got the situation where someone's got a buy-to-let, for instance. So let's take Miss Williams. She runs a successful business, recently sold an investment property for £300,000, lucky devil, but she's got a capital gain. So she's got a gain of £68,700, but after her annual allowance of £3,000, very measly these days, she's got a gain of £65,700. Now, she's a higher rate taxpayer, so that's all at 24%. So she's going to have a tax bill of £15,768. Now, first thing that some people get confused on, to offset that gain, you do actually have to put in the profit. So that gain, to not pay the tax, you have to put in the whole gain. So it's not the tax you're investing to not pay, it's the gain, it's the profit. So that's 65,700 gets invested into an EIS, and you're going to defer that £15,768. Because it was a property, she would have had to have paid it very quickly, that capital gains tax liability, within 60 days. So actually what happens is she would have paid the tax, but you do your EIS. When you complete the certificates, she will get a tax rebate and that money will come back to her. Another misconception is some people don't realise you can also get income tax relief. It's not one or other. To be fair, I think I've only come across accountants who've thought that. Slightly mad. You get income tax relief as well. So at 30% on that £65,700, she's also got another £19,710 back from HMRC. Those are very nice checks to come back. So when you add that up, you're actually thinking, well, actually, how much did she really invest? Because actually, that's 54% tax relief. So that's before we even come into loss relief. How much is she really risking here out of the £300,000 of proceeds? Because that's the key. Because many of my advisors will ask their clients to say, look, you've got your buy-to-lets. So many people are accidental landlords. They didn't mean to be a landlord. They really don't want to be a landlord. Everything seems to be going against them, the poor devils. But they don't want to sell because of capital gains. So as an advisor, I'm always saying, say to them, look, if I could sort out the capital gains, would you sell it? And they go, oh my goodness, yes, absolutely. Can't wait to get rid of it. Same principle if it's a share portfolio, a GIA held elsewhere, you're wanting to get rid of something, but it's going to cause another tax bill. They're reticent, or you're going to take a number of years offsetting their tiny allowance every year. Just say, look, let's be done with it. Let's sell it. Let's give rise to that capital gain. My top tip as well, always work out roughly what the tax bill is going to be because it's generally so much less than they think it's going to be that they actually sometimes say, well, actually, if that's all it is, I'll pay it. Well, brilliant. Then actually they can pay the tax bill. You've released the rest of the money to put into funds under management. If, however, they say, how much? I'm not paying that, that's ridiculous. Um, that's fine. We can do an EIS. Let's put the profit in, put that in. Sometimes we might need to defer it for a long time. We'll come on to that. But basically, what you've done, if you've got rid of their problem portfolio or their share portfolio, their GIA, you've now got all that funds under management and you've got a little bit probably in an EIS. That's when you need to manage it out. So, key point here, you're only ever deferring the capital gain. Now, an accountant did say to me, Dominique, what's the point of deferring something? You're just putting off the inevitable. Another accountant said to me, Dominique, you never pay today what you might not have to pay tomorrow. I liked that accountant personally, but it is a good point, especially with the allowances now being so small. But the beauty of having a diversified portfolio, we go back to that lady, she's put in that 65,000. You might have £6,500 per company. It's not going to be exact, but you get the idea. One company gets sold, okay, great. It's made 3 times profit. You go, Marv, that's brilliant. Yes, but the £6,500 that you put in there, the capital gains becomes payable again. And it's deemed as if it's brought into a brand new tax year. It's deemed as a new gain. Well, the first benefit of that is if it's in a new tax year and it's a new gain, you can potentially, of course, use an annual capital gains tax allowance against it. So now rather than 6,500, they've only got £3,500 deferred capital gain. Well, they could pay the tax on that much lower amount, or you could say, would you like this EIS? It doesn't have to be ours, because they could reinvest that 3,500 and redefer the capital gain. And every time a company matures or becomes a loss, it happens then as well, you can basically offset an annual CGT allowance and redefer anything remaining. And you can keep doing that until you've got nothing left. Or until death, because on death, CGT dies with you, of course. You get CGT uplift. So it's died with you. And once you've held those shares, those EIS shares for 2 years, also qualifies for business relief. So there's no IHT. So what they've done, deferred that initial capital gain, got that tax back, got their income tax back. And as these companies mature, you're going to say, right, where we can, we'll offset your annual CGT allowance. But at the very least, keep reinvesting that amount, keep deferring the capital gains tax until you die. I call it a proper IHT plan. Die, CGT will die with you. You've got your 30% income tax relief and 30% every time you've reinvested, and you'll have no IHT. Hold on, that's 30% income tax relief, 40% IHT, 24% CGT. That's 94% tax relief. And the best bit, of course, it's only ever the gain, that profit, that you're having to manage out. The rest of the money you've actually put into funds under management, into lots of other things, or into business relief, or whatever it might be. But a warning, okay, this is especially pertinent if you're perhaps reinvesting entrepreneurs relief or business asset disposal relief. If you think at the moment, that rate is at 14%. But of course, actually, if they defer it, when it comes out in a new tax year, it could be at a higher rate. And it's going to be a higher rate next year, even at 18%. So actually, unless they're prepared to keep deferring it and keep deferring it till death, actually be careful of deferring capital gains tax, which is at a low rate now, because when it comes up, it could be at a higher rate. So just defer the amount that they think, actually, the worst comes to the worst, CGT rates go from 24% to 40%. Actually, do you know what? I can afford to keep deferring it until I die potentially. Hopefully that doesn't come up, but just be careful of that one. Other points to note. Nothing happens to the money until it's invested in the underlying companies. What do I mean by that? Well, especially for IHT. So if you're doing this as an IHT play, don't think once you've written the application and sent us the check, especially if it's on the 6th of April, the 2-year clock starts. No, it doesn't. It's not until it's invested into those underlying companies. That's when the 2-year clock starts for IHT. So please be careful of that. What also means, though, is for us investing at the end of the tax year, it's wow, that's quick. Investing now, actually, by the end of the tax year, your 2-year clock has started. So actually, for EIS portfolios, we are really quick. So we are not all made the same out there. Exactly the same for deferring a capital gain. So when we look at capital gains, I'm always talking about, well, what if people have got a gain now? You can go back up to 3 years and defer a gain, or 1 year in advance. But again, if you're getting close to that 3-year point, please bear in mind it's not until we've invested in those underlying companies. That's when you've got your 3-year time. Okay. And you can't claim back the tax until you receive the EIS certificates. That's why we make it a priority that we do get them back nice and quickly for you. What else? Well, I've already mentioned this. If we're reinvesting from one EIS into another, it doesn't restart that 2-year clock. Now, although it's IHT free, don't forget it is counted though towards the calculation for the residence nil rate band, so, same as business relief assets and agricultural relief assets as well. Post-death, no liquidity whatsoever. There is no secondary market. So just remember and put it in your report how much tax they're saving, because the beneficiaries will need to hold them until we've sold the shares. Also, the beneficiaries don't inherit EIS shares, they inherit shares. Why is that important? Well, for loss relief, they can get loss relief. So from the date of death to when the company matures, or if it gets sold and it's gone down, they can't claim EIS loss relief and claim income tax back. They can only offset it against CGT. Also, because they're inheriting shares, actually any gains they make from the date of death to when we sell the company, that is subject to CGT, but of course they could invest in an EIS as well. So how do we actually claim the tax reliefs? Well, these certificates are all important. If you do a self-assessment, you can just attach them and say, I've done an EIS, give me back my income tax relief. If it's the CGT, you literally fill in the forms, attach them to your self-assessment, or if you don't do a tax return, just send them in. That's absolutely fine. But you do need those EIS certificates. We do also have a guide to actually completing those if you'd like help on them. Loss relief, though. I often, when I meet with clients, talk about loss relief first because they always love the upside and they always love the investments and they don't even worry about risk. So, but what I do like to talk about is saying, well, look, this could be a disaster. Every single company you invest into could go pop. If we start off that way, it's only going to get better. So I often say, look, you can get your 30% income tax relief. They're often higher rate taxpayers. If everything goes horribly wrong and you lose all of your capital, with income tax relief and loss relief, the maximum downside for a higher rate taxpayer is 42%. Now, what other investment can go down that much and actually have not lost anything? And the maximum upside is unlimited and tax-free. And how loss relief works, it basically increases a client's personal tax allowance. So they get income tax relief at their highest marginal rate. If they were claiming CGT instead, because they didn't have any income tax to offset, then you can offset capital gains in that year or you can carry it forward. Income tax is that current year or the previous year. you can't carry it forward for income tax relief. A very important point to note on EIS loss relief, you must claim income tax relief on the initial investment. And the same goes if you want tax-free growth. You also, excuse me, even though that's on silent, my alarm wasn't. If you want capital free gains as well, again, you do need to have claimed income tax relief at outset, otherwise you don't get it. So just to recap our learning outcomes, I'm hoping now at the end of this hour, you can summarise how and what the Blackfinch Investments team invest into when we invest your EIS clients' money, outline the different tax reliefs of an EIS, explain when and how the different taxes can be reclaimed, who the typical clients are for an EIS, and set out quite a lot of the disadvantages of an EIS and basically make sure you know what to be aware of. I just want to say thank you again for joining me this afternoon. Hopefully you can join me next week when we look at the advanced business relief options. Again, at the end of this webinar, that feedback form will come up. If you don't mind just spending 1 minute completing it, we would really appreciate it. But thank you so much for your time. We really appreciate it. Bye for now.